All right, great. So again, everybody, welcome to this capital markets real estate webinar. I'm your host, Anthony Scandariato. I run a company with my partner who's on actually as well, Brian Leonard, Red Knight Properties. We're a boutique middle market real estate company focused on value add multifamily and mixed use within the tri-state area. We're based in Chester, New Jersey. We have about 200 workforce housing units, including some mixed-use retail in our portfolio. We're seeing a lot of interesting opportunities start to poke their head around that are coming around the corner. Alex, works at Eyzenberg Companies, and Eyzenberg Companies. Alex, you can explain more about what you guys do, but I just want to thank you for coming on here, and we're going to have some interesting conversation here.
Yeah, of course. I'll give a 30,000-foot overview on Eyzenberg for anybody that's not familiar with us. So Eyzenberg Company is a middle market real estate investment bank. So what we are doing as intermediaries is structuring capital up and down the stack. That could be anything in the form of construction loans, bridge financing, structured capital buckets like mezz and pref. We also structure equity up and down the stack, whether that's LP, co-GP, entity level equity. Outside of that, we also manage a $650 million facility to originate PACE loans. And then lastly, we manage a private equity vehicle that we use as a principal to acquire leased fee positions underneath. Could be existing or ground up development assets. That's kind of the long and short for us.
That's awesome. So Alex, can you kind of talk about, we're having this conversation right now. It's May 7th, and we're both in the New York metro area, give or take. What's the state of the market we want to hear from both a debt perspective and an equity perspective. We can start out the conversation in the debt, and obviously the debt revolves around the equity as well at the same time for various different asset classes. So, as we kick it off, what would be, what type of lenders are still lending in this environment on all different asset classes? And we can kind of break it down by asset class. If you want to start with, office, hotel, multifamily, we could kind of break down the list from there.
Yeah, we'll start with multifamily, although it's going to look very similarly across the board until you start getting into call them the less attractive asset classes. So anybody that has a balance sheet that they manage, that could be a finance company, it could be a bank or credit union, or anything that's touching agency financing. They're all liquid. They have capital, they have dry powder they can put out the door. We can kind of go by what constituent we're talking about. So just going through from a risk perspective, life insurance companies, of the 16 that we're tracking right now, 17, 15 are out of market entirely. And one of the biggest has laid off the entire originations team on the real estate desk. Just gone. That happened 3 weeks ago already. If we go into the other balance sheet groups like banks, you have to look at how banks structure and price risk and how do you mitigate risk as a bank. You really only got two levers you can pull. You can decrease your leverage or you can decrease the payback period, right? So you're either doing hyper-amortization or you're just decreasing the term of the loan. So what we're seeing banks doing already is they are decreasing leverage by about 5 to 10% just across the board. Credit unions are still out there. They're still active. They are viewing it similarly to the way the banks are, decreasing leverage. In fact, we just had a term sheet come in earlier this week from a credit union for an office deal where 70 to 75% leverage, 5 to 7 year term, interest rates in a 4 handle, 25-year AM. That's really for underwriting purposes. It's really 30 in reality. But they'll look at some retail and hotel. If we go to the next bucket of balance sheet lenders, or really you can't call them a balance sheet, but the finance companies. So debt funds. And I'm going to break those down into 3 different groups. And we'll start with the ones that are out of the market. Any debt fund that was underwriting to a CLO exit is gone. Poof, out of the market. Any debt fund that had a warehouse facility from a commercial bank or life co that was relying on that facility to place loans on, they are likely not going to be quoting any deals for the foreseeable future. That's due to 2 reasons. First of all, you can't move the product off the line. The second is the banks are already talking about chopping lines. I was in the market with a credit facility deal just a few months ago. We had term sheet, we were getting ready to go to committee, and then this happened, and we don't know what to tell you. Maybe we'll open back up in June, but we've got no idea. The last group of debt funds, and these are the most active in the market right now across all capital types, would be your debt funds that are funded entirely through equity. Those guys tend to be a little bit more opportunistic, but there are some benefits that you can get from them. If you're looking at, let's say you had a bank deal, and you got retraded, whether it's leverage or term or amortization, the debt funds are there to pick those deals up. And they're actually pretty similar in proceeds to where they were before from an LTC perspective. Where they are just gouging your eyes out on the trade is in spreads, which across the board have ballooned from anywhere to 100 to 300 basis points wider from where they were even 3 months ago. I can give you anecdotal evidence. We had a phenomenal deal in Long Island, ground up construction, for sale product, age restricted. We had a term sheet from a lender that was 85% financing with $3 million repaid to the borrower at close. L plus 700, LIBOR was floating at the low ones at the time, non-recourse, and they had the ability to repay themselves at the closing of the units after they hit a 50% pre-sale threshold. Client decided not to take the term sheet against our advisement, and we called the bank or the debt fund back just to check in with them a couple weeks later. They're like, yeah, that's not 700 money anymore. That's L plus 900. It'll be a 2% LIBOR floor. So again, it's debt funds will still be there to rescue deals. It's just going to be pricier money. As we go into the securitized product market, there is good news on that front. CMBS has not been closing for the past month and a half. And frankly, they've had to warehouse a lot of these loans, whether it's on the balance sheet or existing facilities that they have from other lenders. What they have been doing is they are still underwriting deals. And in some cases, you are getting quotes back, but you can't get a commitment. So the good news is the first CMBS securitization has hit the market. It went on Monday. It got good reception. And they expect the next bucket to go out next week. Now, the caveat with all this is all of the vintage in that CMBS bucket was pre-COVID loans. So how the market's going to react to loans that were originated during the coronavirus, we're not sure. I would suspect that the underwriting criteria will change. But that's all to say, CMBS markets will start opening up probably in the next 3 weeks, but you're not going to see a high level of activity until the second half of June. If we go to the last bucket, your agency lenders, they are still out quoting deals. They are still issuing term sheets. Fannie, Freddie, unless you are a repeat borrower that they're really trying to win business from, you're not going to hit that 75% leverage even with waivers. You're going to price out at 70%. You're going to be in a 3 handle on rate. The difficulty there is Fannie and Freddie have a 1-year principal and interest reserve. Now that'll get capitalized into the loan, but it's still technically a reduction of proceeds. I am advising borrowers the next best thing, if you have the stomach to wait for it and you can deal with the reporting on the back end, is HUD deals. So HUD does have a debt service reserve requirement. It's equivalent to, let's see what we had written down here. HUD is a 9-month debt service requirement that'll sit in escrow, but it will get released to you after one of 2 things have occurred. It's either going to be 3 consecutive months of successfully meeting your minimum DSCR requirement, or it's going to be 6 months post-close, whichever comes sooner. That, I think, covers all of the debt that we're seeing out there from a lending perspective. Anthony, if you want me to go into the different debt products and how they're functioning, I'm happy to talk about that.
Yeah, that would be great. But let's take a little step back. So you mentioned, pools of CMBS loans, pre-COVID, and you mentioned that in terms of default rates picking up, we don't know when that's going to happen. But can you kind of talk about what asset classes? I mean, there's different TREP reports you can run to kind of forecast the default rates. What asset classes are going to get hit most with these CMBS loans or any type of loans that are going to go into special servicing?
All right, well, let's pick off the low-hanging fruit here to start. Hotel, that's an easy guess. What I found most interesting in how the hotel market's operating right now, though, is you have nationwide occupancy hitting mid-teens right now. Nobody's traveling, but because they know that the tenant base for who's actually going to be renting a hotel room for the night is not due to want, it's due to need. They have to travel. They've actually got their ADRs pretty much in line with where they were 3 to 6 months ago, right? Because they know that they can still charge the same rate for a room night. Because if you're going to a hotel right now, it's because you have to, not because you want to. You take my word for it, I would say over the next 2 to 3 years, hotel assets are going to trade for anywhere to 100 to 200 basis points wider in terms of cap rates than they were in 2019. There's just no other way around it. And it's going to be a function of, what does your run rate look like in terms of ADR and occupancy? Are you going to be able to underwrite to 75% like you have historically? Probably not. We're talking to some hotel operators that are saying, we're actually going to have to leave rooms open or spaced out 2 to 3 days after somebody checks out because we need proper time to clean it and in case the virus is still hanging around. The next one that's going to get hammered, obviously we all know, is retail. Your mom and pop shops are, if they're not already out of the market, they're going to be soon. Most of your small business retail doesn't have more than 3 to 4 weeks of carrying in their operating accounts. They just can't service it. Your nationwide retailers, they'll get some relief. It kind of depends upon how they're capitalized and how strong the balance sheet is. But what's interesting to note is the guys that are going to get hammered here in terms of delinquencies are the same asset classes that were out of favor 6 months ago. People didn't like hotel before, they don't like it now. People didn't like retail before, they don't like it now. Condo, the last thing I would want to be as a condo developer in Miami right now, building $1 million condos. It's just not going to move. There's nowhere for that product to go. If you want to start looking at the more resilient asset classes, it's the same thing. If it was attractive before, it's still attractive now. Large multi-tenant, multi-family deals, you're going to be fine dependent upon what type of multifamily you're building. And I kind of rope in student housing with multifamily too. So student housing, it's tougher to say because if I'm a student, am I really going to go back to campus next year? Why am I going to spend $55,000 for tuition and room and board when I could spend $22 and do it online? With your market rate multifamily, we'll go from workforce market rate luxury. Workforce is probably the scariest one to be in of all the multifamily product types, and that's just a tenant demographic. Those are people that are living month to month or 2 weeks to 2 weeks. If they lose 1 to 2 months worth of work, they can't cover rent. Now, you do have relief going to multifamily owners if you have an agency loan. If you refuse to foreclose on tenants due to non-payment of rent, you can get a forbearance from the agencies. The next two groups, market rate and luxury, are actually my two favorites, which sounds counterintuitive when the markets are haywire and people don't know if they're still going to have a job. But you think about who's renting a luxury multifamily unit where you're spending $300 to $350 a square foot in a secondary city. Those are people that could have bought a house, maybe they're late 20s to late 30s, and they decided, you know what, honey, I'm not sure that I'm going to have my job next month or next year. Let's just hold off and stay in our unit. We've got 6 months of overhead in our savings. If something were to go haywire, we can still service rent. The last asset class I would probably want to be in, or lastly, would be industrial. And it's an interesting demographic. First of all, is it single tenant industrial? And if it is, well, are they investment grade or are they credit rated? If they are, then you're probably in a good spot. But for your multi-tenant industrial, it's just as good because anybody that's operating a business that has to be in an industrial style asset cannot operate that business from home. If you're Joe's Plumbing or a kitchen and bath retailer, right? You need showroom space, you need warehouse space. You can't keep it in your garage. So they're still going to be leasing. The question is how much activity is there going to be for new leases? If you don't know how much space you're going to need, you're probably inclined to just sit and wait. Spec industrial deals will be tough to get over the finish line unless there's some kind of logistics component to it, and you're at, if you want to be a last mile distribution. I'd say the probably last major food group would be office, and that's anybody's guess. I just don't know what the office footprint is going to look like for large corporates. Is JP Morgan really going to need 2 million square feet of office in Manhattan? Who knows? Are suburban office properties going to be able to keep tenants in place? Not sure. It really just depends upon when we actually start sending people back to work.
Got it. Awesome. No, awesome coverage. So follow-up question would be, we started getting into you breaking down the different buckets of lenders and who's in the market right now. So you mentioned life companies, you mentioned Fannie and Freddie.
Mm-hmm.
You know, what are they lending on? And like you said, if you could kind of drill down a little bit on some of the things you mentioned for people here, you know, leverage and spreads,
Yeah.
you know, are lenders completely out of the market on, like, let's say for hotels or retails in general, or there's some lenders out there that, yeah, sure, 60%, but I want 2 points and, you know, I want a 12 to 15% interest rate and it's a two-year balloon. Like, you know, are those the only types of loans out there right now? And what would you advise to your clients that are in that space that are having issues with financing where they didn't have as many before COVID?
So there's two things at play here. First of all, the type of financing that you choose is not dictated by you. It's dictated by what your business plan is. So the financing plan needs to match the business plan. And secondly, I'll work my way backwards from a risk perspective of the different loan types that are getting quoted in closing. And so we'll start with, you know, the least risky and we'll move to the most opportunistic. So refinancing on stabilized properties, still happening across all asset classes. Like I said, if you're in multifamily, okay, Fannie Freddie is going to dial back the leverage from 75 to 70%. But let's say I'm coming out of a construction loan, hit stabilization. Theoretically speaking, if I was building to a 200 bip spread between my yield and cost and cap rate, I've already created enough value where I could probably cash myself out at 70% leverage. You know, HUD is still actively quoting deals. Banks are still quoting deals for refinances. That market has stayed relatively consistent. And honestly, I would rather be doing refinances all day right now. We've got 10-year treasuries at sub 1. You've got LIBOR, you know, 1 month LIBOR quoting at 0.25. Now's the time to be locking in rates. And if you have to get swaps, go do it. As we move a little bit riskier, so let's talk about transitional. That's probably the second best place to be right now. Transitional is a tangible asset there. There's a business plan. You're probably not going to be stabilizing for 2 years anyways, whether you're doing a CapEx or rehab or renovation, if it's a mark-to-market play on leases or just going through lease up. There's a tangible business plan there. You can probably get bridge debt and close in 30 days at 7 to 9%, 75% leverage, non-recourse. That's there. It's available from the finance companies, so you know, your debt funds. One lender type we didn't cover that I'll just touch on briefly is, you know, the other type of finance company. That's a mortgage REIT. Obviously, we've seen what happened to the stock market. NAVs are just dislocated in terms of how we're pricing the stock on mortgage REITs. They don't have dry powder to put out the door, but those would have been the second group to talk to if you're going for bridge or transitional debt. Next, we go into a riskier bucket, which would be construction. Construction loans are still getting quoted. There's still capital there available. That's where you're really going to see spreads blow out. And if I were to take a deal out to market and go to 50 lenders, I did this 3 months ago, I'd get 40 responses. Now I'll probably get 20. But they're still there at more expensive rates. And then the last group would be your pre-development loans. So I've identified a site, I've tied it up, I've got $3 million of A&E that I gotta cover. I don't want to do it out of cash. The lenders that were there for pre-development loans at 9% are still there, but they're at 13. And what's interesting is they can actually price in that risk premium, and we'll cover this in a second with equity. The way they view it is everything's just been knocked back into a riskier bucket. So, you know, if I'm a hard money lender and I was quoting pre-development deals at 10%, yeah, I can go quote a pre-development loan at 13, but the underwriting risk profile is actually greater because of what's happening in the market. I would rather look at construction deals that just got booted out by the bank. They had a term sheet, but they can't close, because I can now price that construction deal that would have been 7% at 10%. But my risk profile is, and the credit of the underlying entity and the borrower and the asset is better. It's better than it would have been on the pre-development.
Awesome. Can you kind of talk, so we covered debt. Can we talk about equity now?
Yep.
So,
I'll do equity across, the different capital types.
sure.
Toss out stabilized deals. There is no equity for stabilized deals. Not institutional promotable LP equity. That doesn't exist for something like that. Unless you want to go kick it to CalPERS or CalSTRS and they just toss it into their core fund. In terms of acquisition deals, there is still LP equity out there in the market that's going to underwrite it. They're probably not going to be as aggressive. And if you really do have a need to raise LP equity, you should be going to a friendly entity that you closed with before. They're probably not going to look too kindly upon unknown bodies that are coming in soliciting, $5, $10, $15 million checks, unless you really have a track record behind you and a solid business plan. On construction deals, just forget it. There is no LP equity in the market right now for construction, unless you've done $2 billion with one of three groups over the past 20 years. You're not getting those things over the finish line for LP. So I would advise clients, you need to start getting creative in how you're structuring those deals. So we have a couple avenues that we can do it through our proprietary products, right? So we're an approved HUD lender. That's one way to do it. If you have a strong enough balance sheet, you can go up to 85% leverage fixed at 2.6% non-recourse over a 35-year AM. Great option if you can cover that 15% delta. The second replacement for equity is you can go out there, if you're in one of 22 approved states, you can go use CPACE, which we have a $650 million facility that only originates PACE loans. That's similar to HUD leverage, where I can go up to 90-95% of the stack non-recourse. Pricing is 400 bips wider than HUD would price, but it's worth it to replace equity, and I actually had this conversation today. We're talking about common equity or pref equity. What would you rather take? Would you rather take an 8 pref that's also capturing up to 50% of the waterfall? Or would you rather pay flat 6% amortized over 30 years? I'll take option 2. And lastly, equity for pre-development just doesn't, that wasn't happening before coronavirus. It's not happening after coronavirus. We take a pretty strong stance. Pre-development dollars that have to go out the door are the responsibility of the sponsor, the principal, the GP. That's their job. Once they have all their A&E and construction budget costed out, and you're ready to close on the construction loan, that's when the LP equity will step in and fund. In terms of the deals that LP equity is going after, it's actually similar to the comment I had earlier. Why would I take a construction deal that's going to give me an 8 pref and up to 50% of the waterfall when I can just go pick up a distressed asset 3 months down the road that has a much lighter lift and same returns because I'm buying it, a cap rate that maybe is 50 to 100 bips wider than it was in January. So there's a lot of dry powder sitting on the sidelines, both at the GP and the LP level, that's looking to pick up anything that is distressed. That could be distressed notes on single family, that could be distressed debt on commercial assets, or it could be distressed assets. I will say for those of you that are out there waiting to pick up distressed assets, you're going to be waiting a decent amount of time. Real estate is a lag compared to the rest of the economy, right? With the public equities market, they can price out risk and what's happening very quickly. And the bid-ask spread is fairly consistent. With real estate, you need tenants to stop paying, you need your DSCR to start dropping below 1, then you have to go into default. It's just the waiting time is not worth it, in my opinion.
Mm-hmm. No, it definitely makes sense. So when do you think those opportunities are going to happen? Like, you think it's not going to be till 21?
I wouldn't say 21, but I definitely would say 3 to 6 months from now. I would, if I were going to be making distress plays, I'd be going after distress notes. The problem is a lot of those notes on the commercial assets haven't hit the market. Really, the only notes that are floating around right now in portfolios are on single family. And those were things where they've been in default and ready for foreclosure for 5 years. So that's, the problem is you're going to have to be really competitive to pick up these distressed deals, and you're not the only one doing it, right? So if you have a bid-ask spread that's really determined by supply and demand, if you only had $1 billion chasing these distressed deals 3 months ago, and now you've got $6 billion chasing these distressed deals in August, it's going to drive up the price. So are you really going to get the discount that you were perceived or you were underwriting to? Probably not. It's hard to say. Let's see.
Yep. Awesome. So in terms of equity, you mentioned construction and every other asset class. Is it very similar to, like you said, for debt? Like, who's the most aggressive lender on, let's say multifamily or industrial? Is equity still the LP equity? for the GP side, is that still relatively easy to get? What, it obviously has to have value add because, like you said, stabilize, unless it's 1031 exchange money, in my opinion. They did extend the deadline to July now, so you might see a slew of 1031 buyers start to pop their head out very soon. But outside of that, what other kind of capital buckets, are allocated towards the safe asset classes in this downturn?
I would say it's relatively similar to what it was just a few months ago. Multifamily continues to be one of the most attractive asset classes for equity. Same thing with industrial. Office is a bit harder to say. It kind of depends on where you are. If you're looking at Class A office, infill location, Manhattan, yeah, there's still going to be buckets of capital out there for that. If you're talking suburban office properties, there has to be a heavy, heavy value add component, and you need to be deep in the weeds, way down the road in pre-leasing discussions. And you need it to be with very sticky tenants. Retail, if a client came to me with a retail deal looking to raise equity, I'd probably pass. And same thing with hotel. You're not going to find a dime out there of equity for hotel deals. It's just not going to happen. You're getting a hard enough time getting debt on it. There's no way LP is going to look at that for all the same reasons I said earlier with the difficulties that hotels are going to run into. That being said, they'll pick up distressed hotels that, their current occupancy is, they're going to underwrite to current occupancy, not the future, and they'll throw a 10 cap on it. But then you're back in the world of distressed deals. Different types of capital buckets out there. One of the interesting trends that I'm seeing, and we're structuring more and more of these deals, are the concept of a co-GP that really functions as an LP, or an LP that's somewhat functioning as a co-GP. And what I mean by that is there are a lot, as we were in the top of the market, there were a lot of new developers out there that maybe had 1, 2, 3 construction jobs underneath their belt, and they're trying to scale up. The problem that a lot of these guys run into is twofold. It's net worth and post-closing liquidity. So when you're going out for a construction loan, you need a net worth that's roughly equal to the loan amount. A lot of lenders will kind of look past that. But the second and more important one is, what is your post-closing liquidity? It needs to be 10 to 20% of your hard costs. So on a $100 million development deal, and approximately 60% of your costs are hard costs, so we're not talking 60 million, you need post-closing liquidity equal to 10 to 20% of 60 million, so 6 to 12. There's not a lot of developers out there, unless they're operating under an entity, that have liquidity of $6 to $12 million. So what we're seeing now is this role of the co-GP that steps in. And this is not a new concept. It's been happening with contractors, general contractors in New York for a long time. But the co-GP will step in and say, hey, you know what? You can borrow my balance sheet for your completion guarantees, but I want to take a cut of your promote up to 50%. So rather than the waterfall flowing down, promoting an LP interest, you now have this partner with you that's capturing 50% of that waterfall. The other way that you can do it, if you want to avoid giving up that much to promote, is you can go find a large GC that's willing to post their balance sheet for 2% of whatever they're posting.
Sure. Awesome. And so when we're talking about the capital markets, does it matter for geography, location-wise in the country on any of these projects?
So the way that I would look at that is, and I say this in jest to clients, but it's true, don't bring me to Tacoma or Milwaukee, right? It's certain lenders going to be looking for kind of the smiley face, right? So we're going to look at that Northeast down to the Southeast to the Sun Belt back up to the West Coast, and then 2 dots in there for Denver and Chicago. Yeah, I would say geography matters, and that's also going to determine who you go to, right? So if I were pricing out, one of your multifamily deals in Jersey, I'd say if it's sub $8 million that you're raising, you're probably better off going to a local bank. They're going to understand the market. They're going to understand what the demographics look like. They're going to be comfortable with the fact that it's in their backyard. As you start scaling up and you're going to 10, 15, $20 million loan amounts, and this is the same thing with equity checks, that's when you can start going to the more institutional players, start going to debt funds. But that's all, again, driven by the market. If it's $80 million in Wichita, I'm going to have a hard time finding an institutional guy that's going to look at it, whether that be a debt fund, mortgage REIT, CMBS, bank, doesn't matter. It's going to be hard to find that kind of money. You're going to be better off with a local group. I continue to be bullish on the Southeast across almost all asset classes, but definitely multifamily. I'm still bullish on anything that's probably really anything that sits on the East Coast. It's just a function of, are you in Boston or are you in Baltimore? Because those are going to have two very different risk premiums in terms of how they price and what the leverage looks like.
Awesome. Well, that's great. So what I'd like to do now, because it's coming up at 2:45 almost, I want to open up. I'm going to unmute everybody and take you off the spotlight here. And we'll open up questions and conversation. And, everybody feel free to participate and ask questions to Alex. It's not that often we can have someone like Alex here. So definitely want to encourage conversation.
Yeah. Sounds like we're on extreme ends here. He wants a cheap deal, and the landlord's not really going to budge too much on the rent at this point. So, maybe we just put it on hold and see where things go.
All right. So that guy's doing something else.
Yeah.
So what are your thoughts on the mobile home parks in this market? True workforce housing.
I love mobile home parks just because they cash flow like crazy. I view it kind of similarly to self-storage. Your overhead and your operating costs is so low that, on a cash-on-cash easily in the teens on a current basis. So what I will say is it's going to be very difficult to find equity and place equity for mobile home parks, and that's less so a function of returns, more so a function of check size. And we run into this issue, same thing with storage, right? How often do you see self-storage deals that are greater than $15 million? If I'm an institutional LP managing a $500 million fund, I'm not putting $30 million slugs out the door. It's just not going to happen. It's not worth it. So from a lending perspective, you're best going to leverage you're after. You go after debt funds. If it's pricing, then just go to a local bank.
Anybody else have questions?
Yes, Victor here.
Yeah, Victor.
Alex, if you had a project that you had most of the capital raised and like you said, you can't really go out to the market at this point and raise additional equity for new construction, would you consider cutting the scope of the project down by phasing it, even if it means that the takeout on that first phase is not going to be as attractive because you're going to be burdening it with higher upfront costs? What would you do? Would you wait? Would you consider phasing it? What are your thoughts?
Well, that's tough, right? Because now as you phase it out, you're getting multiple financings that are occurring over the hold period, which is going to cause you to incur frictional costs. And
Correct.
those would be, a reduction of proceeds on the front and the back end. You may not get the cash out that you need. I would say I would look to the different product types, some of which I had mentioned, and it will depend upon what state you're in and what classes. I would look for some of those gap capital types. The first one that pops to mind is if you go for mezzanine and layer that on top. That depends on how levered you are, how large of a check size you're trying to raise. The other possibility is if you're in a state that's approved, you can go after PACE. And there's no shortage of PACE lenders out there that would be more than happy to put $200,000 to $2 million out the door like that. I think absent those two things occurring, I would probably, I'm inclined to say phase it, but it really depends on how large the gap is, right? If you have the ability to raise $1 to $2 million by passing the hat, yeah, okay, wait a couple months. But if we're talking about a larger delta here, then I would probably break it up and phase it.
All right, cool. Thank you.
Sense. Anybody else? Questions? Comments?
Yeah, can you hear me?
Yeah.
Yeah. Hi, Andy Murray from Rubenstein Partners. Hi, good to see you. We have a mortgage, open-end mortgage capital fund vehicle. I originate for that. We're in the market. We're active. We focus 100% on it. So I guess my question is, following up on you mentioned you have a value add deal, an office deal. You mentioned you went from 40 to maybe 20 bidders. I don't know if you meant just whether that was relative to office or just across all asset classes, but You know, our competition has been generally insurance company funds that are in that space. Curious if the insurance company funds are still in that space, or have they pulled in on that, on those kind of loans? Number one. Number two, you know, what would the 20 different, are the 20 different groups that from 40 before, are they all debt funds, or are there banks involved there still? How do you see that as your prime, you know, candidates for those kind of deals?
All right, so we'll address the first question.
20 to $80 million deal, middle market stuff, you know.
Okay, so on the first question with regards to the life insurance companies, I'm looking at, you know, kind of where you guys quote roughly L500, 65% LTC, 3-year deal, down pretty cookie cutter down the fairway. You're not going to get that much competition from the life insurance companies right now. As I said before, of the 16 or 17 we're tracking, 15 are out of the market completely. One of them is laid off, and this is a huge life co, has laid off their entire originations desk on the real estate side. Of the ones that are still quoting, you know, I've heard numbers in like the 40-ish% leverage point. So if you're out there, if you got dry powder that you can put out the door at 65% LTC, you're going to win those deals all day. And you know, L500 really, that's not expensive. That's not expensive money for value add deal. I would take that all day. And with regards to the constituents we would go to in the capital markets, where it's, you know, if I went to 50, and now I'm only getting 20 responses. That's just kind of a broad stroke. That it's not just debt funds. As I mentioned, all the debt funds that had leverage, whether it's a 1-to-1 or 2-to-1 advance rate, those guys are taking a pause. But if we're doing a construction deal, and it's, let's just use office for example, you know, I'm gonna make a market between both the debt funds and finance companies like mortgage REITs as I would with banks, understanding that I want to give the client an array of options. Right? Because if I go to a bank, it's going to be recourse, but it's going to be decent leverage with a lower rate. If I go to a more opportunistic group like a finance company, I know that I'm going to pay 100 to 150 bip wider spread on the rate, but in exchange, I'm getting partial recourse or entirely non-recourse or some kind of recourse that burns off throughout milestones during construction.
Okay.
Anybody else? Thank you, Andy.
You're welcome.
Tim asked, we covered mobile home parks, but Tim's wondering about co-living. How is coronavirus going to affect co-living financing? Even I don't work on co-living, so I don't even know what was available before coronavirus.
I do not look at very many co-living deals. I can tell you this, just let's put capital markets aside. Would anybody want to be looking at co-living right now, to actually live there during a global pandemic where we're forced stay-at-home orders? I wouldn't want to look at that for another 3-6 months. I wouldn't even look at that until probably 2021. And the financing that was out there before is coming more from the opportunistic buckets of capital. You know, I haven't closed a co-living deal before, but I would be hard pressed to I'd be hard pressed to get an agency loan on something like that.
I'm curious too. Anybody else?
Hey,
I'm curious.
Oh, go ahead. No, go ahead. If somebody else.
Oh, yeah. Just curious what you're seeing for medical and hospital assets.
We're seeing a lot of quotes out there. We're seeing a lot of deals coming through. You know, let's focus on hospitals. It's tough to underwrite that as a real estate investment bank because it's so heavily focused on operating income that you might as well just consider a corporate business, and it might be better suited for the corporate finance world. There's no shortage of healthcare investment banks out there that specialize in this. So I think it's hard to say. Medical office is very attractive right now, and there are a lot of deals that are getting thrown around. I think we actually just picked one up. I'm not staffed on the deal, but I know we just picked up a medical deal just last week. So it'll be interesting to see how that shakes out.
Yeah, and in my experience, medical office was hot before coronavirus anyway.
Yeah,
So.
well, it's very specialty use, right? It's the build out that you're going to do there probably really means that, depending upon how you structure the TIs with the business that steps in there, it's going to be pretty sticky tenants.
Sure. Anybody else? Andy, did you have a comment?
Yeah, I just had a quick follow-up. I meant to ask this before. Same scenario we were talking about. what LIBOR floors are you seeing across the industry? I've heard a variety of things, but generally in the 1.5 to 2 range. Are you? I mean, it depends on what you're doing, but I'm guessing I'm talking about sort of the floating rate bridge space.
Yeah, and that's another one of those kind of, like fingers sticking up in the air. I have seen term sheets come in with 2% LIBOR floors. I would, if you really want guidance on where to price with the floater, I would be looking historically back at where LIBOR's been over the past 18 months, sans the coronavirus time period. And I know I've talked to other lenders that are saying, I've talked to other lenders who are saying, you know what, when we're underwriting, we're going to look at what the cash flows and what the interest rates looked like 6 to 9 months ago. And that's how we're going to treat it.
Great. Any other questions? No, I think we got one more. So this question is, let me check my chat here. If you're a younger real estate investor looking to break into the market, where do you suggest we start in this market? So I can answer that with you, Alex, but go ahead.
Yeah, I think actually I'm gonna defer that one to you, at least to start, and then I can jump in and add color.
Yeah. So the person who asked that question, feel free to connect with me after. But I would narrow down, obviously, what asset class you want to consider investing in. If you're interested in multifamily or mixed use, you could reach out to me or Alex to connect after. But you need to figure out what you want to invest in, and that's going to become, I think, more prevalent once we get closer and closer to being out of the virus. But if you're a younger real estate investor, typically most younger investors, if they don't have institutional experience, if they're not coming from another, larger sponsor that had different asset classes, you're probably going to focus on residential or multi. It's just in my experience. So, I would definitely focus on residential, but make sure you know what you're doing. And what I would say is I would partner up with, whether it's on the GP side or with another LP. Don't do the deal by yourself, just especially not in this market. If you've never done a deal before, definitely have partners involved to help you every step of the way. So, Alex, I don't know if you wanted to add to that, but that's what I would have.
I would echo all that entirely. I think multifamily might be a tough entry point, but if you can focus on that 1 to 4 unit space, yeah, you are dead on. Go get a co-GP. You're gonna give up 50 to 55% on the promote, but that's okay because what I mentioned earlier, right? That co-GP, that's really LP. You're gonna need that balance sheet, whether you're buying or building. You're gonna need to borrow somebody's balance sheet, and there's a lot of issues that you're going to have to navigate as well as you're going through zoning and permitting and the various pre-development stuff, that's pre-development costs that have to be incurred. So I would agree, definitely partner up.
Yeah, outside of 1 to 4 family, definitely partner up. Even on a 1 to 4 family, definitely see if you could partner up for your first deal, at least. If you had no previous real estate experience, I would recommend that.
Yeah.
And then we got a question from Steve. Where did you say commercial bank spreads are on long-term stabilized multifamily over LIBOR? Alex? I can speak to that too, but go ahead.
Yeah, I would say, well, I mean, really historically, LIBOR's traded, in that somewhere in a one handle. So I would say on stabilized multifamily from a commercial bank, you should be targeting 200 bips over LIBOR. I think would be a good day. I wouldn't be upset with that, right? Because that's 3.5% money. I'd say that's reasonable. It's kind of hard to say.
Sure, but most of the times, Alex, if it's stabilized multifamily, they're typically not quoting over LIBOR. They're quoting over the Treasury.
Yep.
Right. So, Steve, if your question is more on the bridge side, I have some experience there. I mean, Alex, you can correct me if I'm wrong. Yeah, they're starting to put floors in at 1.5, 2, and then depending upon your leverage, multifamily. Really, what I've seen is it depends how strong of a sponsor you are. The stronger your, like Alex said, net worth, your balance sheet, your infrastructure. It definitely helps substantially by 50 to 100 basis points on your rate, and maybe even 5% on your leverage. So, stabilize, usually it's over the treasury.
Yeah, which, I'm looking at it right now. Really you're somewhere within that. If you're talking treasuries, you're somewhere within that 2 handle, which still, if you can get 150 to 200 bip spread over a 2 handle, that's probably in line with market.
Absolutely. Before we wind this down a little bit, Alex, can you kind of talk about just rates in general? Do you think that, just on a high level, do you think that over the next year they're going to go up or down? Like, just high level.
Yeah, and I actually had this conversation with my colleague, and I've heard it from David as well. Rates will probably stay relatively low over the ensuing 6 to 9 months. They will work their way back up over the next 12 to 18, where they're going to hit pre-coronavirus levels. And it's not like we're going to see something skyrocket up to, where your benchmarks are 4%. That's just not going to happen. But for now, I would be, if you have the ability to borrow anytime in the next 6 to 9 months, start locking this stuff in.
Absolutely. All right, so we got a couple more minutes. So if anybody has any closing questions, we'd appreciate that. And people are kind of winding down now.
Yeah.
One additional question. What about event venues, wedding venues, things like that are more specialized, where there's clearly still demand as long as they can continue to operate in this environment? Do you see opportunity to refinance those, or is that pretty much shut down at this point?
Yeah, so that's going to come down to what kind of financing you want to get, because you could be leaving a lot of money on the table depending upon what you choose. So, for example, if you just came out of construction or a value add deal on an event venue and you're thinking about going to perm, I would hold off on that, because they're going to underwrite to your T12, and your in-place cash flows due to what's happened with coronavirus. Nobody's going to event venues, and they probably won't be for another 3 months. I would definitely not go for permanent financing. I would go to an opportunistic group like a debt fund and say, listen, we had a historically good T12 pre-coronavirus. What I want to do is bridge for the next 2 years. And what we want to do is we'll underwrite based off of the pro forma cash flows, not the in-place cash flows. That will allow you to maximize the amount of dollars that you can actually get into the deal. Now, what's important to note about that is bridge financing is not meant to cash out sponsors. You can get away with a little bit, a couple percentage points, but that's not the point of bridge. Bridge is meant to be transitional to take it from point A to point B. And if you think you're going to funnel any cash out of that deal and decrease your, take pretty much anything out, they're going to look at that and say, you know what, let's go to a bank and go get a perm deal if that's what you want to do.
And Victor, just to clarify, is that on standalone venues?
Yes.
Okay.
Yeah. Or standalone or with some amount of hospitality embedded, but the majority of the revenue would be from the events themselves.
Anybody else? It's 3:00 now, so we'll do one more question and then we'll wrap it up. If anybody has.
No.
All right. Well, great. Well, awesome. Thank you so much, everybody, for coming on. We will be sharing this live webinar via email. If you had to leave early or want to just have a replay again, feel free to also reach out to Alex at Eyzenberg. You can find him on LinkedIn, right? When we send out an email, I'll have Alex's information. If you want to reach out to me, I'll have my information. If you want to continue the conversation. And again, thank you so much, everybody, for coming on, taking time out of your busy Thursday, and hope to do these again. Hopefully we'll see you again in a few months and kind of give us an update on everything going on.
Yeah, that'd be great. I appreciate it, Anthony. Thank you for having me.
All right. Take care, guys.
Thanks, everybody.